I want to start this discussion today by making an assertion that this is an accounting universe. This planet we call home is an accounting universe. And why do I make that assertion? If you can scrutinize the activities that we undertake in our lives, may it be in life or in business, you are going to find that there is an accounting connotation attached to it. If at all, if you could reverse engineer those activities and use a microscope, you'll find that at the core of those activities is an accounting DNA. So, if you look at that activity, you will realize that what holds it together, what brings it together is accounting. Now, to support that assertion that is an accounting universe, we can go a little bit further and look at the activities that we undertake in our lives, throughout our lives, and also in business. For example, when you wake up, you face a bill, you are confronted with a bill. That bill, whatever it may be carrying, maybe is a bill to do with you paying rent. It carries an accounting DNA in it, with it. It has got an accounting component in it. Now, if at all it is to do with the business itself, how do we run our businesses? We run our businesses, but then the how we run the business is the accounting that does that. As we move further, you find that we normally talk about the cost of living. And what is this cost of living? It means that you cannot live without incurring a cost. But cost itself is a component of accounting again. Again, as we move further, you'll find that we look at all the activities that are surrounding us, that you cannot avoid accounting and go anywhere far. For example, when you have to determine your tax liability, again, it's to do with accounting. When you receive your payslip, it's to do with accounting again. There's an accounting element in that. When you receive your bank statement, again, it's a byproduct of accounting. You see. Then, when we come to government, how a government run, the way that governments are run also carries an aspect of accounting. That's why you will find that good governance equals good accounting. We can't talk about being accountable without bringing accounting into the mix, because you are accountable to what? What is the benchmark that we are looking at for us to say that you are accountable? Accounting comes into play. Again, and very importantly, if you look at the economy itself, how the economy is run, for the economy to be run efficiently, and for the economy to be able to produce the desired results, again is backed up by accounting. So you find that whatever we do is driven by accounting. It's that aspect that we cannot be able to avoid. So, as we look at these things, we realize that accounting is all pervasive. It's all pervasive because the things that we do, the things that we undertake in life and in business, it is carried by accounting. So we cannot be able to run away from accounting at any given moment. So it is better for us to come on board. You see, we have to come on board because accounting is happening in our lives. What happens to our lives is accounting. So how can you break away from such an important part of life? You cannot be able to divorce it. For example, if you were to put it into more context, you'll see that you'll be like a fish and accounting is the water. If you put it in the right context, you are the fish, but accounting is the water, which helps the fish to survive and which ensures that the fish becomes nourished. You see, so our lives and accounting are intertwined. Business life and accounting are intertwined. And hence, accounting and business. And hence, life and accounting. The other point that we need to understand is that accounting itself is a precursor of management. What comes first is accounting, then we can manage. And of course, we cannot be able to manage without accounting because we'll be managing from which perspective? What is guiding us to do this managing? So that's how all pervasive is. And that is why accounting is for everyone, because it is what happens to our life, whether we like it or not. That's what happens to our life. Now, what we need to undertake today is something that is very important. We need to build the financial statements from scratch. That is the core of this discussion. How do we build the financial statements from scratch? I'll tell you something. We've got a problem, and that problem is the accounting phobia. Accounting phobia is that tendency of keeping away from any accounting information or accounting knowledge. And you'll find that accounting phobia has been inhibiting us from coming on board. And now that we know what is accounting phobia, those barricades that you have in your mind that you cannot understand the subject, those situations that makes you run away. Now, how do we deal with this accounting phobia? There must be a way in which we deal with it. But you'll find that we can only deal with it when things make sense. If things don't make sense, we cannot be able to come on board. So, as we start building these financial statements, which are so important because financial statements is the mirror of the organization or the entity. If you want to take it further, you'll find that it is like a medical certificate that shows the financial well-being of an entity. And if you want to even take it further, it's like an X-ray certificate that shows exactly where the problems are hidden. So the financial statements are very important. But now building it becomes overwhelming. Hence the accounting phobia. It's what is stopping us from making those steps towards understanding this all pervasive subject. So the biggest question here is this: where do we start? How do we start building these financial statements, which are so important, which tells the story of what is happening? You do business, but once you have done business, the how of how you did the business is the accounting that gives you that. It's the accounting that gives you that details. And that is where the financial statements comes in. And then when we put these financial statements under the microscope, we are able to see the nitty-gritties. We are able to see all the issues that were happening, and we're able to make decisions and to make corrective decisions or make improvements or move forward. So, for us to be able to build these financial statements, we have to answer this pertinent question: where do you start? Where do we start? Of course, for now, you have come to realize that you already know so much about this subject. You cannot be able to say that you don't know anything about this subject, because this subject is what is happening to your life. Even as we speak right now, something to do with accounting is happening to you. You are receiving an invoice, you are receiving an order, you are receiving a notice to pay. If you are paying your mortgages, you are receiving those foreclosure messages, you are receiving those tax certificates or those tax claims. You are receiving all that. So you are interacting with accounting on a daily basis as long as you live. As long as you live in this world, it is one thing that is a must. It's one thing that you have to contend with. So back to our question: where do we start and not get overwhelmed? Now, for us to be able to start, we must make sure that we don't lose the logic. We have to make sure that things move systematically. So where do we plug in whereby we don't get lost? Whereby the accounting phobia does not set in? That is a very big question when it comes to this subject and when it comes to learning accounting. Where to start? But now, I'm PK and I am your accounting nitty-gritty specialist. I will show you where to start. You start at a place where connecting the dots is a natural thing. You start at a place where you can connect the dots very easily and then you build. Because as you can see, you've got the fragments all over. You've got the fragments of accounting from different aspects or from different dealings that you have in life. So, for us to be able to start, we have to start at a point that makes sense. We have to start with a solid foundation. And where is this solid foundation resident in accounting? Where is it placed? For us to be able to know exactly what we are doing, not just the pieces and the pieces and the pieces, which end up giving us problems at the end, which end up causing the accounting phobia that we talked about. Because all these fragments don't make sense. But if you could bring all those fragments back, we can use them to construct, to build these financial statements. Now, we are going to start at a point whereby we deal with the elements of the financial statements. The elements of the financial statements. That is the most logical place to start. That's where we can plug in. Once we plug in, then we can connect the dots. Because remember that we think logically. If there's no logic, we cannot continue. So we have to build the logic first as we move. So the elements of financial statements is the most logical place to start. Because those elements represent themselves as an accounting compass so that you can navigate. The elements. These elements of the financial statements, as we are going to see, it is the foundation, it's the base of the whole accounting system, irrespective of the size, irrespective of the data that you are confronted with, or irrespective of the data that you are dealing with. All of it have to be placed somewhere in the elements of the financial statements. And ideally, these elements of financial statements are five. Ideally, they are five. You start with number one is the assets. The assets of this business. Okay. Number two, you'll find and be followed by the expenses. Those are the expenses. Number four, we have got revenue. That's number four. Number five, we have got capital. Now this 3, 4, 5. And then we have got your liabilities. Those are the 5 components of financial statements. You can add another one which you can call other. But now with these elements, if you put them together, these are the ingredients. So the ingredients that you use to be able to build the financial statement. And you'll find that all manner of financial statements are built from this base. So this base have to be understood. Before we can move any further, this base have to be understood and how it works. Because these are the ingredients that we use. For building, we would say that this is the bill of quantities. That's how we are in building. This is like the bill of quantities that helps us to construct that structure. For accounting, it is the elements of the financial statements. This should be the most logical starting point, which will be able to bring together all the knowledge in a manner that we don't get lost on the way. Now, when we talk about assets, what are we talking about? Again, we have to be careful how we talk about these elements, or how we talk about the assets, because we have to put it into context. For it to make sense, we have to put it into context. And how do we put it into context? We look at a business as a case study, any type of a business as a case study. Let's think about supermarkets. For you to be able to run a supermarket, what do you need to have in place? Now, when you look at the things that you need to have in place, then already you are talking about the assets. For example, it's a supermarket, you need the fridges, you need the building, you need the shelves, you need the point of sale, you need the trucks which deliver the goods, you need all that. Now, when you talk about all that, now you are talking about assets. You see, you don't have to talk about assets in isolation, because once you talk about assets in isolation, it will not make sense. There will be a problem there. There will be some resistance there. But then, if at all you could put it in the context of a certain business, you're in the logistic business, for example. What do you need to set up that business? Of course, you need the trucks. You need some storage. You need all that. Now, that is now making sense, because we are looking at the assets from the perspective of the business. If you are running a small shop, like a haircut business, what do you need? Those cutting machines becomes your assets. Now, it becomes easy for you to deal with these technical aspects of accounting by looking at the reality of it. The reality of it is you look backwards. You look backwards, and when you look backwards, you'll find that it only fits well when you talk about a certain business. It's the only time it can fit well. Otherwise, it will not make no sense. But then, when we are still here talking about assets, I can hear some questions that are in people's minds. We always talk about your employees being the best asset. Now the question is your employee an asset or not? We are going to answer that question as we continue. Another question that can arise here, which is an accounting nitty-gritty, it is advertising cost. Is the advertising cost part of an asset? Again, some people may argue or may think that really it is part of an asset, because you are using it to gain more ground, to gain more market, and to be able to gain more revenue, so to speak. You are using it to expand the business. So somebody may say that this one should also be part of the assets that the business is having. But then you'll find that it may not actually fit into the asset. Now, the next thing we are going to find after we look at the assets, and of course the assets are those investments, that base that a business is using to be able to be competitive, or to be able to meet its mission, or to be able to meet its objectives. That's the asset. Whatever you require to be able to compete. Yeah? But then, if you look at the assets and the expenses, the difference is normally very narrow. But now the expense represents the day-to-day activities that you undertake to be able to run that business. You are paying rent, you are paying fuel, you are paying your wages, you are paying your overheads. All that falls under the category of expenses. You see, what helps you to drive the business. The difference is not so much between the assets and the expense. That is why they are next to each other. Now, when it comes to revenue represents what you get out of the business activities that you are undertaking. That's a narrow definition, because if you expand it, it can involve other things. But The definition we want to look at this time round is that revenue is what you get from your business activities. When you are selling, what do you get out of that business? Looking at your strategy. What strategy are you using? And how healthy is your revenue? Again, we can ask ourselves that question. How healthy is your revenue? Are you just depending on one source? Are you just depending on one customer? If you are depending on one customer, there is a question mark on how that business can be sustainable. The next thing is the capital. Capital is what you introduce into the business, if the business is new. But if at all the business is not new, it is what remains when you look at the assets minus the liabilities. It's a residue. What remains? When you take all your assets, then you remove all your liabilities. That's now the net worth. What remains? That represents the capital. It represents the capital. Now, we move on. Looking at liabilities. What are these liabilities? These are obligations. As you run your business, you end up incurring some liabilities, or you end up incurring some obligations that you have to meet. In other words, this is money that does not belong to the business. This is money that does not belong to you. Those are the liabilities. Now, the other represents some items that are either assets or liabilities at the same time. Others is at one time is an asset, at another time is a liability. This is like a hybrid car. A hybrid car which is using gasoline and also using electricity. Those are the others category. Now, we are talking about these elements of financial statements. Where are they anchored? Because if they are not anchored somewhere, then we are going to have financial statements that are prepared using different elements. You find financial statements that are not uniform. Our financial statements will not be uniform. So these elements of the financial statements, you'll find that they are anchored on the conceptual framework. The conceptual framework is what defines the elements of the financial statement. Is what defines these elements, such that when it is an asset, it has to meet some certain criteria to be able to be an asset. Not everything is an asset. It has to be looked at from the perspective of the definition given in the framework. Because the framework brings order, it brings structure into the reporting system. So for us to be able to show something as an asset in our books, for us to be able to record something as an asset in our books, it is because it has met that definition. And that is why you will find that your employees, although we say that they are our best assets, they cannot fit in this definition because our employees, the value of our employees cannot be measured reliably. And that is one of the criteria that we use to determine an asset. You see? So the value of those employees cannot be measured reliably. Because tomorrow, if at all the employees want to leave, they will still leave. Again, the contributions they make, how do we measure that? There is a problem in there. That is why you cannot be able to find employees being recorded as part of the assets, of which these are the resources that the business that is using. These are the resources that the business is controlling and the business is using. Those are the assets. Now, advertisement, again, it falls under the costs. It falls under the cost because, again, it cannot be measured reliably. How do you know the amount of business that your advertisement effort brought to you? How can you measure that reliably? Again, that's why it cannot fall under the asset category. So, you find that all these elements are anchored in the conceptual framework so that we can have uniformity when we are preparing or when we are building these financial statements. We have to always go back here. That's why I said this is the most logical starting point when dealing with accounting. Because if you don't get this right, you won't be able to navigate. This is your compass. It shows you the direction. Without it, you'll be all over the place. You'll be scattered all over the place. Without it, you will not be able to connect the other dots, as we are going to see as we build. So, for the assets, how do the assets behave when we are recording them? So, when we are recording the assets, you'll always find that our assets, using our T account, our assets will always have a debit balance. Always have a debit balance. Those are our assets. Then the balance will be carried down on this side. When we balance off this account, after we perform our accounting ritual that we perform periodically, when we balance it off, you'll find that our assets will always carry a debit balance. That's like the great north. We are saying the elements are a compass. But then now when we go deeper, you find that for us to be able to identify the great north, so that we can know the direction, assets will always carry a debit balance. If you find your assets have got a negative balance, because it's now like positive when it comes to an asset, and this is negative. So if you find your assets are reported in a negative manner, they have got a negative balance or a credit balance, then it means that there's likely to be a problem. But we have got one exception to that rule. When it comes to the cash can be negative when you have taken a bank overdraft. So your cash can be negative, can carry a credit balance. But otherwise, all assets should be able to carry a debit balance by default. That's by default. If other things have not happened, by default, your assets should carry a debit balance. That's your assets. When you look at the other component, which is closely related to the asset, it is the expense. The expenses. When we look at our expenses again, using our T account, of course, it's debit and credit. Because of the concept of duality, debit and credit, and debit and credit because of the concept of duality. Again, our expenses will always carry a debit balance. That's what's going to happen to our expenses, just like assets. So, if you know what happens to assets, then automatically you should be able to know what happens to the expenses. Again, if you see a negative balance or a credit balance, then you have to investigate. It means that there's likely that there's a problem somewhere. You have to investigate, because by default or naturally, our expenses should be able to carry a debit balance. Now, let's go to the others. Let's look at our revenue. Our revenue, again, using our accounting crucifix, debit, credit, our revenue will always carry a credit balance. That is by default. Everything works according to how it should work. Your revenue should always be a debit balance. Yeah? And then the balance brought down should be on this side when you balance off. I mean the balance carried down. Balance carried down should be on this side when you balance off. So you see, our revenue is behaving the opposite of our assets. Okay? So the balance in our revenue account is always going to be a credit balance under normal circumstances by default. Then let's look at our capital. Our capital will follow the same trend. Our capital under normal circumstances, so debit and a credit, our capital will also carry the same like our revenue. We'll always have a balance, we'll always have a credit balance, which will be carried down on the debit side. So the balance carried down in our capital account should be on the debit side. Again, you can see our capital and our revenue are behaving the same way. Then you move further and you look at the liabilities. The liabilities. Our liabilities will behave the same way because our balance will be a credit balance naturally. It's going to be a credit balance. Then the balance brought down, balance carried down should be on the debit side. And that's how you balance off your liabilities account. So what I would expect you to observe is that assets and expenses, they behave the same way. Revenue, capital, and liabilities behave the same way. Assets and expenses will always carry a debit balance. Then revenues and capital and liabilities will always carry a credit balance. That needs to be noted. As we form the basis of building the financial statements, that needs to be noted, that needs to be underscored. Because if we get things wrong here, we don't have a chance of proceeding. So our assets, debit, expenses, debit, then revenue, credit, capital, credit, liabilities, credit. Now on the other, you'll find that there are certain items that one time is an asset and another time is a liability. That's why I put that category of other. But predominantly, the elements of financial statements are 5. Now, our assets, where are they used? Our assets are used in the balance sheet. That's where you find our assets. Our assets are in the balance sheet. Our expenses are in the profit statement. That's where they are. In the income statement. Income statement. Those are our expenses. Our revenue is also in the income statement. That's where our revenue is. How about our capital? Our capital is found in the balance sheet. How about our liabilities? Our liabilities are also found in the balance sheet. In the balance sheet. So every component, every element of the financial statement is where it is used. And we have to make sure that we also align that. We also have to understand that these elements are not just used anyhow. There's no way I'm going to find liabilities in the income statement. There's no way. It will not be possible. There's no way I'm going to find assets in the income statement. There's no way. So we must be able to align our assets and our liabilities and our elements of financial statements in the right manner for us to be able to undertake the task of building the financial statements. Now, having done that, we can have a snapshot of these financial statements. Because we are saying that our financial statements primarily is the balance sheet and the income statement. So, if we can have a sketch of the balance sheet, there's a sketch of the balance sheet. It's right there. What do you expect to find in our balance sheet? You are going to find our assets, and our assets are going to be classified because accounting is all about classifying, processing and classifying so that they can have meaning. We are going to have some categories of assets, okay? But you'll find that our assets will be reported here. And we are going to have some headings that represent these assets. We're going to have that. And then, this is going to be the asset side of the balance sheet. Then we go to the other side of the balance sheet, which is going to carry the capital right there. And then it's going to have the liabilities right here. You can add the two, you'll find that our balance sheet is balanced because it has to satisfy the accounting equation. And the accounting equation is that our assets are financed by capital and liabilities. So that's why it has to balance. The balance sheet equation is such that our assets are financed by the money you brought in and the liabilities that you are using. And that's what makes our balance sheet to balance. If it doesn't balance, it's because you did not use the concept of duality in full. The concept of duality means what? For every entry you make, you must make an equal and opposite entry. That's the basis of accounting. That's the foundation of accounting. For every entry you make, you must make a corresponding entry. So for every debit, there is a corresponding credit entry. And now, when we are here, you have to make sure that you cannot continue. You can't move on before you grasp how the elements of financial statements relate with each other. How we mix those ingredients such that we can end up coming up with a financial statement. The other one is the income statement. Just a sketch. It will be beefed up with information as we move. The income statement. What appears in the income statement? We start with the top line. That's the revenue. The revenue is reported right there. Okay? Of course, this revenue will have some cost. The cost of sales, for example. You have the cost of sales. Cost of sales is what you incurred when buying. We are assuming that this is a trading company. Now, when you buy, you incur some cost. Even if it's service, when you provide a service, you also incur some cost. So those costs will be reported here such that we get our gross profit. That's our gross profit. You see? Then our gross profit will be now subjected to the other expenses, whatever they may be. The day-to-day running, those expenses that helps you to be able to run your business. And these expenses must be aligned to the business. They have to be legitimate. Now, for the assets as well, they have to be legitimate assets. It has to be legitimate. It has to be aligned to the business strategy. You cannot have outrageous assets looking at that type of a business. Every type of a business will have some assets that are naturally supposed to be used in that business. Also, the expenses the same way. Even the liabilities. What kind of liabilities are we incurring? Are they legitimate liabilities or not? So, we are going to have our expenses here. We'll be deducting. Then we get our profit. That's how we derive our profit. And now, this is just a snapshot of those financial statements which we are feeding from the elements of the financial statements. They are getting these ingredients, these components from the elements of the financial statements. So, from day number one, we can be able to start thinking about the financial statements by using those elements, mixing them up in an appropriate manner. Because when we're looking at the strategy, whether it succeeded or not, we'll be looking at how those elements were mixed together, how those elements were used together. That's what is going to determine whether our strategy is working or not, whether there is wastage or not, whether we are efficient or not. Because when we are efficient, we make more profit. When you're not efficient, we start making losses. Yeah? And it starts from far. This starts from far. It starts from how you put together your assets. And then what follows after that. Yeah? Are your expenses legitimate or not? They may not be legitimate. Yeah? Is your revenue robust or not? It may not be robust. Are your liabilities well thought about? Are you paying too much interest on these liabilities or not? Yeah? Again, you should look at that adequacy, because all these elements must come together, and then we should be able to build those financial statements. Then from those financial statements, we put them further under the microscope, and then we'll be able to tell whether things were well integrated, because a business must be well integrated, smooth as well, for it to be able to make sense. It has to be smooth for it to be able to achieve the objective of making profit. If it is a commercial business, it has to be able to be smoothed out. Just be able to run in a coherent and consistent manner. All the dots must be connected and everything must be in place for us to be able to be proud that we are undertaking a robust business or a sustainable business. All these things have to come together. Now, another point that is worth making, another nitty-gritty of accounting, is that if you look at all these components of the financial statement, the one that carries the biggest space is the assets. The asset carries the biggest space because this is the base that we use. You hear the asset base is the base that we use, and this is where a lot of finances have been sunk in, and that's why we are saying that these assets better be aligned to the business activity. You see, for example, you are running just an average supermarket. Why do you need to buy a private jet? What's a private jet for? Again, yes, it's an asset, yes, but it doesn't make sense when you look at it from the perspective of that particular business. But maybe when you look at big supermarkets like the Walmart, for example, which is in America, you'll find that maybe they may need a private jet to be able to fly their executives everywhere in the world where they are operating. Maybe that can make sense. So all we are saying is that things must fall in place and things must meet the test of common logic. Things must meet common sense. When you look at it from the outset, is it making sense? Why are we so heavy on assets? We are just starting the business, but then we have over capitalized that business. How are you going to make adequate profit to keep the business running? Why are you sinking so much finances? Why can't you use it on other things? Why can't you even invest it and make some extra finances out of it, or extra money out of it? You see? So, as we look at these elements of financial statement, we must start scrutinizing. We look at them with an eye of scrutiny. Everything we look at here, expenses, are they legitimate? Revenue, is it adequate? Is it adequate? Are we sure we are gonna be able to grow this business? Are we sure we are gonna be able to keep on running the way we are running? Are we getting out of line? Are we getting out of fashion? Are we being overtaken by the competitors? Just looking at the revenue. Are the competitors posing a threat to us? Yeah? Look at capital. Is it adequate? Do we need to introduce more capital, or do we need liabilities? Again, there must be a balance there. If at all the liabilities are too much, then what's going to happen is that when we have got problems, or when the business slows down, then we will not be able to pay our obligations, and then the business will be called into question. The business can end up going into bankruptcy because of that. So, in a nutshell, the best place to start, or the best place to plug in, is by looking at the elements of the financial statements, and also remember that they are anchored somewhere. They are anchored in the conceptual framework for the preparation and presentation of financial statements. That's where they are anchored. Such that not anything that just comes in as an element. Only what meets the definition is what can be used as an element of financial statements. You see? Now, having said that, you'll find that now that we've been able to identify the elements, then we now need to beef them up. We need to beef them up so that these financial statements can be fully prepared to represent all the items that should go under each head. Because in accounting, what we do for us to process, we classify, we sort, we filter. Then we come up with adequate classifications that make sense. So, for us, as we move further, we'll break this down, we'll zoom in here and see all the items that falls under assets. Zoom down, zoom down, zoom down. Then, at the end, we'll be able to make comprehensive financial statements. And one point that is important as a nitty-gritty in accounting is that it doesn't matter the size. As long as you have mastered the foundation, which is the elements, everything else will fall in place, irrespective of the size of the entity, irrespective of the amount of data. All this data can be adequately contained by these elements. That's what we're talking about, the elements. They can contain any amount of data. It doesn't matter the size. Small, medium, big, and huge. It will be contained here. And all the financial statements will be having the same look. All of them. Because they will have assets, they will have expenses, they will have liabilities, they will have capital, and they will have revenue. All types of financial statements, irrespective of the type of the business, they will be able to carry that. Now, having said that, please remember that I'm PK and I'm your accounting nitty-gritty specialist, and I do more than this. I'm also a corporate trainer. I've been training under winners, professional trainers, in a number of topics. I've also collaborated with other institutions like the Institute of Internal Auditors and Institute of Chartered Accountants on CPD topics, which covers IFRS updates, also covers IPSAS, also covers the international auditing standards. Now, for the internal audit, I've dealt with the IPPF, which are the internal audit standards. But what excites me is when I'm taking the board of this committee through what they need to be efficient. Because you find that the board audit committee, they'll be managing from the top. But when you ask them where to start, that question is always not answered. I'm also excited when I'm dealing with the development of a practical risk register, which is robust, which answers to the issues that the entity is facing. Having said that, you need to go to the previous video, and in the next video, we'll be putting the trial balance under the microscope. Having said that, see you in the next video. Thank you.